Strapped colleges are making deals with banks to let their students use IDs as debit cards. I'm David Gillen reporting for Business Day Live. Michael de la Merced will also be joining us and looking into the I.P.O market in the wake of Facebook's troubled debut. And Peter Evis reports on an idea for the bond market while the crisis in the Eurozone continues. But first, financial institutions are teaming up with some colleges to make it easier for students to spend their financial aid. Andy Martin's been following the story and he joins me now.
Morning.
Morning, Andy. Every time I see your byline on a story about the soaring cost of colleges, my heart sinks a little bit more.
Anyone with kids.
Right. So what's going on here? Colleges are teaming up with big financial institutions to actually almost outsource the disbursement of financial aid.
Right.
Have banks gotten in trouble for this kind of stuff before?
They have. I mean, banks keep going back to colleges for, because there's a lot of potential clients there.
Target-rich environment, okay.
Target-rich environment and a chance to sort of establish long-term relationships. They did this with credit cards years ago where they were giving away sweatshirts and things to get people to sign up. Congress banned that. They had problems with student loans where they were paying colleges and financial advisors to steer students to their student loans. Congress banned that. Now what they're trying to do is get these students to use debit cards, and oftentimes they're co-branding the student ID. So it'll be David Gillen, Rutgers University, and it'll have a little Wells Fargo emblem on it. And the idea is that these students, when they get their financial aid, that they'll just put it right into a Wells Fargo account or right into a U.S. bank account. And the problem here is,
that's what I'm getting at. Are kids getting snookered here? Is that
in some instances, yes. I mean, in some, look, you have some sympathy to the colleges. They're all strapped for money. States are cutting funding. There's pressure to keep down tuition. They're looking for ways to save money and make money. But the problem here is that, like what happened with debit cards for you and I, a lot of these come with fees that the students are familiar with.
I'm shocked.
Yeah, you're shocked. Well, you could imagine. I mean, you get a refund. You get part of your student aid. Say it's $2,500, and you go to get it from a non-Hire One or non-Wells Bank ATM, and you get hit with a $3 fee. So you're paying fees on your student aid money. And then, of course, there's overdrafts. There's some of them have fees if you use a PIN-based a PIN-based transaction as opposed to a signature transaction. All sorts of the fees that Congress already addressed some years ago.
Right. Now, some of the colleges that you mentioned in today's report, you've got University of Florida, Michigan, private schools like Penn, Northwestern. I mean, what do these guys say to this? What are they saying about this?
Well, what they're saying is, I'll give you an example of Ohio State signed a deal with Huntington Bank. They got $25 million out of it. And Huntington Bank agreed to invest $100 million in the neighborhood. They're saying, look, at a time when states have cut our funding drastically, this is a new, innovative way that doesn't cost students more money. It's a way for us to make money without strapping students with higher tuition fees. And every one of them will say it's a good deal for students. We vetted it to make sure they're not getting hosed by these fees. But really, you have to look at every individual deal. There are, even the authors of this report at US PERG will say there are examples where, students, it's not a bad deal for the colleges or the students, but there are some that students are getting snookered.
Okay, Andy, I await your next report with great angst.
My pleasure.
Now we're going to turn to the financial markets, where Facebook's I.P.O. last week did more than just disappoint some investors. The lackluster performance of the dominant social network shares may also have had a wider chilling effect. And Michael de la Merced is here in our newsroom to talk about the already weak I.P.O. market. Good morning, Michael.
Good morning, David.
So Facebook's faceplant, it's kind of, put a chill then on the entire I.P.O. market. Kayak, the travel site, has apparently pulled its offering or delayed it.
David, Facebook's IPO has had a lot of problems. It's really shaken a lot of confidence within the IPO markets. IPOs are ultimately about confidence. And with Facebook plummeting the way it has, there's been a lot of problems with people just not really feeling confident in investing in IPOs.
This has got to be a black eye for the bankers as well. They must be a little nervous. Morgan Stanley has come under a lot of criticism for it, the way it handled Facebook. And I think it was on Kayak too. How worried are the bankers?
Bankers are feeling a little, they're feeling a little hurt by this, and they're trying their best to stir up the markets. But at this point, they're confronted with things that are somewhat beyond their control. Facebook's already out of the gate, and now they have to confront with Europe, which certainly has not been helping the markets. And so there are a lot of forces that bankers feel are beyond their control. So at this point, they just feel like investors aren't really willing to invest, and that's kind of hurt the IPO market a lot.
I'm wondering if some of this, though, too, is investors realizing after all the hype and hoopla surrounding Facebook that, wait a minute, new stock offerings, there's a lot of risk associated with this kind of investment. Is that partly what's also going on here?
I'm sorry, David, could you say that one more time?
Yeah, I'm just wondering if people are more or less coming around to this idea or being reminded painfully that IPOs are risky investments.
Yeah, IPOs are very risky investments, and that's something that people had forgotten. People assume that you buy into an IPO and the stock automatically rises, and that's not always the case. And Facebook provided a really tough lesson in just letting you know that, yeah, sometimes you buy into these investments and they go down.
All right. Thanks a lot, Michael.
Thanks.
Finally, since the sovereign debt crisis in Europe began, people have discussed the possibility of creating euro bonds. And that would mean that countries that use the euro as a currency could pool their debts. This would help countries like Spain and Greece avoid a possible default. But more creditworthy nations like Germany are sharply opposed. And to talk us through the debate is Peter Evis, who's been reporting on the crisis in Europe for some time. Good morning, Peter.
Hey, David.
So, on and on it goes, and things are not getting better. In fact, they're probably getting worse. I mean, at this point, why not try for a silver bullet solution like these Eurobonds?
Well, I think Eurobonds are probably one of the more difficult things, one of the more difficult silver bullets to pull to get in action.
Right.
I think they require the electorates of each country probably to sign off on it, which will be kind of difficult to get, because if you're a German voter, to what extent are you going to want to shoulder the fiscal deficits of other countries? It would be like asking the American people to, say, shoulder the deficits of Mexico and Argentina, and it's not an easy thing to sell.
Exactly. I mean, we were down in the newsroom just before, and I was saying, like, isn't this sort of like Florida saying, okay, I'll have to stand behind, I don't know, Idaho, and you can't imagine voters in Florida and taxpayers in Florida would be thrilled with that idea.
No, they wouldn't. But there is some sort of pooling in the U.S. which kind of works because of more than 200 years of history make it work. There are other solutions or other silver bullets they might try for. I think
what else?
I think they'll probably try. If things get really bad, they'll just have the European Central Bank just go in the market and buy up, tens of billions of dollar bonds. They don't really want to do that because it kind of lets some of these countries off the hook. But if things get really bad, I'm sure that's what they'll resort to.
Now, I know that everybody in the financial markets is waiting on the Greek election. I mean, how significant is that going to be in this as this?
Look, I mean, the whole Greek election thing is kind of a bit of a red herring in some ways, because even if the party that really wants to stay in the euro, that is promising to do some reforms, actually wins a majority and a big majority, they still have to sort of push through all the things that nobody wants to do anyway. Do you know what I mean? So it's like you can have the best possible government, but you still can't get anything done.
All right, Peter, thanks. We'll be watching it. That's all for today, but please stay with us online at nytimes.com for our continuing coverage of this and other stories. I'm David Gillen, reporting for Business Day Live. Thanks for watching.